Now, similarly, having now also run out their naked short silver book at the expense of actually a dwindling volume of short speculator open interest left to actually short cover into, collectively, these same bullion banks who have stealthily built very long in-house physical silver positions, they've started to come out publicly too, to also talk up their long silver book. Yes, the footprints were pretty darn clear. When we recorded that last episode, silver was evidencing strong Chinese, Asian demand, but it was at $33. But with supply shortages hard to hide, impossible to hide, and just about every single bullion bank long silver for their own books, which we've been tracking for a long time now, we actually had the ingredients for a rally into the season. In fact, so much so, it turns out the banks have actually front-run the July season by a full month. Normally we see silver strong in July. So perhaps a quick look at the charts would actually be helpful. And it's really more important to look at the general direction and what we're expecting. And in fact, the very first sign that the bullion bank cartel was planning to short cover ahead of season was on the first trading day of June, which was here. And where spot silver took out the next round number. If you remember, we've been consolidating. And when we were talking about, in our last episode, we were talking about the 33 spot level. These are futures charts, so there is slight adjustments because of the contango between futures and spot. But essentially, on the first day of June, suddenly we blew through, or silver blew through, the 34 spot level, which is approximately $34.08 in futures. And not only did it blow through, and it immediately has now become support. So I didn't even get down to testing it before it was front run. Normally we see a pullback, So essentially that is where we first saw the rally. Then once again, now last Thursday was interesting. This is really when silver's mispriced 14-year underperformance breached a large resistance at $35. We saw the $35, which is right here, and actually hard testing and really triggering short stops at $36. Now the contango expands a little to 12 cents at that price, and it will in fact expands a little bit more to 14 cents when we get up towards 37. But essentially, this is what we were looking at. And this has created a historic inflection point. And guess who was on the short side? It was actually the siloed speculators here and here that got royally rinsed. And what we've evidenced is really this inflection point. We're talking about the cartel having repatriated sufficient bullion. Collectively, they've allowed silver to decisively break out of a 14-year capped range. And so really, when you think about it, we're now dealing with a 14-year cap range. In fact, on Thursday, silver futures went bid only, forcing a massive short squeeze upon sleeping specs who'd become acclimatized to selling billions of dollars of bets against silver rising out of this 14-year capped range. Now, as we know, and we've done in episodes about this before, it's the highly leveraged options traders that get carried out feet first, because when the leveraged cash bets they have made against whatever the asset class is, but in this case it's billions of dollars of paper bets against physical silver, and once they're called in, it happens all at once, and the market can suddenly go bid only, and losses to buy back these naked short bets can far exceed enough cash reserves to close these bets. In other words, it can bankrupt the short seller. Most people think of options as buying options. Now we're talking about aggressive selling options at the top of a sequential range in the hope that it will come back down. And it has worked well for them. But when it goes bid only, look at what happens. Now we're in the process of seeing the first two signs of going bid only. Now, given there are several naked short CTA structures, commodity trading advisor structures still vulnerable for margin calls, liquidity providers are betting we may see some further bid-only setups developing. Now, while these speculator bets are little more than collateral damage around what is really a multi-year Fed-held OCC FX bets against silver, and we talked about the OCC FX bets, which are largely in the Fed's hands, and they can obviously, because the Fed's controlling them, they can be cash settled by way of a series of keystroke entries, much as we saw when that happened after the Shanghai Futures Exchange caught the short sellers wrong-footed. And really then we saw this sequential series of higher stair steps devolve. Now we're seeing similar action in silver. And what that's going to do is when these bets are settled, even though they're cash settled, it's going to force much, much higher prices. Now, while the headline data evidences the silver cartel is now building one of the largest ever short positions against a race by speculators to now chase a rising price, because silver now looks like it's going to even outperform gold at this point, and due to position concentration, there'll be an opportunity for these agent bank pit managers to orchestrate some wash and rinse cycles along the way. And we've seen a little bit of that here, but we think it's going to be, they're not going to go naked short. And so what's happened is, really, when we look at these bank positions, they're actually, because they're long their own books, what they're doing is they're hedging. These shorts are hedging physical positions. Now, obviously, they're not one-to-one, but they're not naked short, which means that dips will be shallow. To explain this, it would be a good idea to address the gold-silver ratio part of the question. Now, most of these official derivative bets against silver have migrated into the ratio trade, driving an otherwise implausible gold-to-silver disconnect where it's taken up to 120 ounces of silver to buy just 1 ounce of gold. And while this has now begun to unwind, it still requires over 90 ounces of silver to buy 1 ounce of gold. That is unsustainable. And the level of synthetic silver leverage is just not plausible. And while the natural ratio should be, say, 10 ounces of silver to buy 1 ounce of gold, valuing silver at current gold prices at $300 an ounce, liquidity providers figure an interim gap close to 35-1, which is pretty much what we saw at the end of the 2011 sell-off, which was the sell-off from $50. And even with gold currently at underpriced levels, it would put silver at $100 an ounce. And that is realistic. Now, the gold-silver ratio trade is now actively in the process of harvesting asymmetrically imbalanced short bets against silver. So bottom line, silver's short hedge against gold is being called in, which involves selling gold to buy silver. So you see a bit of weight on gold. But this inverse trade has massively expanded after the bullion banks came out of the gate last Thursday, literally to buy silver, and involved selling some gold. Now, short term, as silver is left to run higher to begin to close the imbalance, obviously it's weighing on gold a little. And the activity we're seeing now is the usual volatility around CPI. Even though it was a miss, you get the usual gaming around those levels. So there we are, gold and silver as we are today. However, with China actively alchemizing this synthetic imbalance, buying both physical gold and silver, both gold and silver are in the process of securing higher physically supported stair steps. Now, this is the core reason why the silver cartel is not naked short silver against a rising price. Now, notably, we're now evidencing silver being talked up, just as we experienced in gold when the Bullion bank cartel moved to become fully Basel III compliant. Now, realizing the BRICS physical market dog was actually wagging the shrinking COMEX derivative tail, and they had built up very long in-house physical gold positions, if you remember. This is when the cartel of bullion banks began publicly talking up their long gold book. You remember, they were talking about 4,000, 3,500, 4,000, 4,500 even. Now, similarly, having now also run out their naked short silver book at the expense of actually a dwindling volume of short speculator open interest left to actually short cover into, collectively, these same bullion banks who have stealthily built very long in-house physical silver positions, they've started to come out publicly too, to also talk up their long silver book.